Welcome back to Trading Hour. Time for some market fundamentals now. Prateek Parekh, the equity strategist at Nuvama, is joining in. Prateek, good morning. Thank you for joining in. Start off by asking you about the only cyclical overweight that you have, that is large private banks. And after a prolonged period of lull, they're finally starting to fire when it comes to returns at least. Why? What's driving this overweight that you have, barring the value? Beg your pardon, this valuation comfort that you have on that? Do you see them narrowing the valuation gap with the others when it comes to this stock price performance? And what about the deposit growth concerns that many of these lenders are facing as of now? What do you expect the second quarter to look like?
Yeah, hi. Thanks for having me over. So yes, I mean, today's market, private banks are one of our key overweights. And there are 3 or 4 reasons for them. First is, private banks have not done well, not just from a stock returns perspective, but even from an earnings perspective. Throughout most of FY24, their earnings underperformed the broader market. And this, along with merger-related and company-specific issues, led to a big derating in the space. But now we see 2 or 3 variables changing. First, I think their earnings growth is reconciling with the broader markets. Broader markets earnings growth too have started to moderate, and we expect the gap between private banks earnings and rest of the pack earnings to be very minuscule going ahead. Second big factor that is changing is, I think, on the liquidity and on the deposit accretion point that you mentioned. We are of the view that deposit problem is just perhaps over exaggerated. The main reason for deposit growth being slow is that the bank's balance sheet growth has been weak, and that's to a large extent attributable to low government spending. Owing to elections and those kind of things, government was sitting on large cash balances. That is now starting to ease. Liquidity overnight, that which we call as LAF, which was in deficit, has now moved into surplus. And on a durable liquidity basis, I think liquidity is still quite ample. I mean, fundamentally for banks, deposits are an outcome of credit creation. Banks are special agents. They don't need deposit to lend. If liquidity is easy and you have credit opportunities, whether it's lending to government or lending to private sector, deposit growth will automatically come. I think with government balances being eased, clearly this is one concern which should moderate going ahead. The third factor which is driving our overweight on private banks is the unusual valuation distortion. I mean, today, if you look at across sectors, after the recent rally in FMCG and IT, there are very few sectors where we can say that valuations are not at their all-time highs. In this context, private banks is a space where valuations are one standard deviation below their long-term averages. And this valuation gap between broader market is perhaps not warranted at a time when liquidity is easing and their earnings differential or the earnings weakness that they were having is narrowing. And that's the whole reason why we are overweight on the private bank space per se.
Okay, so Prateek, you're overweight on the private banking financial space, but what you're not very positive about is what is happening in the US despite the Fed rate cuts that have come by. You say the macro indicators are not looking very sanguine right now. Can you explain that to us? We're starting that Fed rate cut cycle. What would it mean generally, and how does it compare to what we've seen earlier?
Yeah. Thanks, Sonal, for asking this. I mean, clearly, with Fed embarking on rate cuts, it does mark a new phase from a market cycle perspective. Fed is still the most dominant central bank in the world, and its rate cut has ripple effects across asset classes and policy making in the rest of the world. Now, generally, one would expect that rate cuts to, really boost equities of sorts per se. But if you analyze the past 3 rate cut cycles of US in the last 20 years, markets have either been range bound or have moved lower. In 2001 rate cut cycle, market corrected by 35% after a 25% fall the previous year. In 07-08, market initially rallied, but eventually corrected as the US mortgage crisis cropped up. And in 2019, which is the pre-COVID rate cuts, their markets was largely range bound. The reason why history defies theory is simply because that Fed is generally playing a laggard to the growth cycle, and Fed's policy act with a long and variable lags. And generally, when they start cutting rate cycle, they are mostly delayed and they clear cash down to growth. It's only when they are quite deep in rate cut cycles and rate cuts have already seeped into economy that they start having a healing touch and they start improving the earnings or growth outlook and overall market sentiments. This time around, if I look at the macro backdrop in US from a labor market standpoint, clearly it is weakening. The good part, though, is that Fed is trying to play catch up much faster. It has started with a 50 bips rate cut, which maybe a month back was probably not anticipated, and definitely not a 3 months back. So that I think is comforting. But from a growth standpoint, I think the trickle down of rate cuts to growth will still take a lot of time. And in the meanwhile, I think from a growth standpoint, we could be worse off because our own domestic demand is not very great. The margin tailwinds that are there in FY24 are missing, and the export outlook, is still not very clear or rosy. We have just come out of contraction, but the recovery is still very uncertain, Sonal. And that's why in this context, we believe that rate cuts alone are not enough to revive the growth cycle. We need an economic or a demand engine to sustain the earnings momentum going ahead.
No, fair point, Prateek. But then the three instances that you mentioned, the market underperformance with the Fed rate cut were marked by one-off events, right? The 2001-2 was the dot-com bust, 2007-08 was the financial crisis, then the COVID, of course, that happened when the Fed had to bring rates down to zero. Would it be prudent to link these to a normal Fed rate cut cycle? Part one and part two is if the Fed does continue to ease the way it is, what does that do to flows into markets like India?
Yeah, again, a good question. See, I think the events that they eventually played out in 2001 or 7-8 were an outcome of the underlying weakness. It's only in hindsight that it feels obvious that, it's because of the events that things have moved out. But ex ante, we to take a call whether Fed is timely or delayed, I think we need to look at the overall macro backdrop. From that standpoint, if I look at the labor market levels at which Fed cut rates in the previous cycle, I think we are at those levels. It's not like Fed is very ahead of the curve and and is cutting rates. But nonetheless, I think there is merit in that this time private sector balance sheets are not so dampened, and to that extent, it should be comforting. If Fed does continue on this aggressive path of 50-50 basis points going ahead, it surely will act as a sentiment breather for markets. For emerging markets in general, that could act as a cushion. It will help, improve the liquidity and to some extent valuations, but we don't think it will still aid in the earnings recovery per se. And in such context, our view is that money will find its way into two pockets. One, places where valuations are reasonable, and second, where cash flows are strong and earnings uncertainty is low, which is the defensive SPAC. And that's how we are positioning for the market in the current context per se.
Okay, all right, Prateek. It was great chatting with you. We have a lot more questions, but completely out of time. But thank you so much for joining us with your insights and this interesting study with what's happening with Fed rate cuts, but not really translating to what we are seeing on the ground in the US economy. Time for a short break now. On the other side, we'll be joined by the management of rights to discuss the recent order wins and the business outlook going forward. Stay tuned.